Oil crossed $108 a barrel on Tuesday. That number alone would be alarming. What makes it structural is that the Strait of Hormuz, the 21-mile passage carrying roughly 1/5 of the world's daily oil and gas trade, has been essentially closed for 9 weeks. The 2026 Iran war did not just disrupt a shipping lane, it removed the world's single largest oil transit choke point from the equation. Goldman Sachs estimates that Persian Gulf crude output has been curtailed by more than 50% in April alone. Nearly 500 million barrels have already been drawn from global stockpiles. Vital Group, the world's largest independent oil trader, warned that the war will ultimately erase roughly 1 billion barrels of production. The IEA called it the largest supply disruption in the history of the global oil market. Drivers in the United States are already paying the price. The national average for regular gasoline hit $4.18 a gallon on April 28th, the highest of 2026, up 27% since the war began in late February. That jump is not just a pump problem. It feeds directly into headline inflation, pushes bond yields higher, and changes the calculus for every central bank watching price data. The 10-year Treasury yield climbed to a 3-week high of 4.38% on Tuesday. Markets are fully pricing a rate hold at the Fed's 2-day meeting, which concludes Wednesday. But the deeper question is whether a hold is enough, or whether sustained oil-driven inflation eventually forces the Fed's hand. WTI crude rose more than 3% on Tuesday alone, after reports emerged that President Trump rejected Iran's latest Hormuz proposal, which left nuclear negotiations for a later stage. Trump has been explicit. Any deal must address Iran's nuclear program. Without that, the strait stays closed, and the energy math stays broken.
Then, against that backdrop, OPEC itself cracked. The United Arab Emirates announced on Tuesday that it is leaving OPEC and OPEC Plus effective May 1st, ending nearly 60 years of membership and pulling out the cartel's third-largest producer. The timing was deliberate. UAE Energy Minister Suhail Al-Mazrouei told CNN that the exit was chosen now precisely because the Strait of Hormuz is already restricted. The impact on prices would be minimal in the short term. What matters is the long term. OPEC's production quotas had been capping UAE output at roughly 3 million barrels per day, while its installed capacity sits above 4 million. State-owned ADNOC has a target of 5 million barrels per day by 2027, with a stated ceiling of 6 million if demand required. Leaving OPEC removes the handcuffs. For Saudi Arabia, the implications are serious. The UAE had been one of the few cartel members with both the capacity and the discipline to hold to quota. Its exit mirrors Angola's departure in 2024 and Qatar's in 2019, a slow structural bleed of the bloc's production discipline. Analysts describe the withdrawal as marking a structurally weaker OPEC for the long term. Companies with UAE production exposure, ExxonMobil holds 20% of its global capacity there through ADNOC joint ventures, and Occidental Petroleum operates Al Hown's gas, could benefit from any future capacity ramp. The short-term paradox is striking. The UAE's exit, which in normal conditions would signal more oil supply and lower prices, arrived precisely when no UAE barrels can reach global markets anyway, because Hormuz is closed. The market read it as a structural signal about OPEC's future, not a near-term supply increase. That is the kind of collision that keeps oil elevated even as the logic for lower prices accumulates underneath.
While the oil story dominated macro sentiment, technology stocks delivered a separate shock on Tuesday. The Wall Street Journal reported that OpenAI recently missed its targets for new users and sales, falling short of the growth milestones it had projected to potential investors. The report hit OpenAI partners and AI infrastructure names hard. Nvidia, Oracle, Advanced Micro Devices, and CoreWeave all declined. The Nasdaq 100 closed down 1%. The tension here is not whether AI demand is real. Hyperscalers have committed $650 billion in 2026 capital expenditures for AI data center infrastructure, a 71% year-over-year increase. Vertiv Holdings raised its 2026 guidance to $13.5 to $14 billion in net sales, projecting 29 to 31% organic growth. Bloom Energy reported Q1 revenue of $751 million, up 130% year-over-year, crushing estimates by 42%. The infrastructure layer is running hot. The fault line runs between infrastructure build-out and application monetization. OpenAI has roughly 800 million weekly active users and a for-profit subsidiary valued near $1 trillion. But weekly active users do not automatically translate into revenue. The question Wall Street started asking Tuesday is whether the demand curve for AI applications is growing fast enough to justify the pace of infrastructure investment.
That question will be answered, at least partially, when Alphabet, Microsoft, and Meta report earnings this week. Their cloud and AI revenue numbers will either confirm that the application layer is keeping pace or validate the OpenAI miss as a broader signal. Coca-Cola beat Q1 estimates on Tuesday and rose more than 3%, a reminder that consumer staples are absorbing the macro pressure more cleanly than tech. Starbucks also beat, posting 50 cents EPS against a 42-cent consensus on $9.53 billion in revenue. The weight of evidence points toward continued oil-driven inflation pressure for at least the next 4 to 6 weeks, as long as Hormuz remains closed and Iran-US talks stay deadlocked. That keeps the Fed on hold and bond yields elevated, a headwind for growth stocks and a floor under energy. The recovery scenario requires a credible ceasefire framework that includes withdrawal provisions, something neither side has put on the table. If that framework emerges, oil drops, yields ease, and the rate cut timeline compresses sharply. The benchmark to watch Wednesday is not the Fed rate decision itself, it is Jerome Powell's final press conference as chair, and whether his forward guidance on inflation acknowledges the oil shock explicitly. If it does, the market gets a signal about how Warsh will inherit the chair. If it does not, the uncertainty premium in rates stays where it is.